The Federal Reserve, commonly referred to as the Fed, serves as the central banking system of the United States. Established in 1913 in response to financial panics, particularly the Panic of 1907, the Fed was designed to provide the nation with a safer, more flexible, and more stable monetary and financial system. Over a century later, it remains a crucial institution in shaping the economic landscape of the nation and, to some extent, the global economy. Understanding the multifaceted roles of the Federal Reserve is essential for grasping contemporary economic policy and the application of monetary theory. One of the primary functions of the Federal Reserve is to conduct monetary policy, which involves managing the supply of money and credit in the economy. The Fed utilizes various tools to influence economic activity, primarily through setting the federal funds rate, the interest rate at which banks lend reserves to one another overnight. By lowering the federal funds rate, the Fed aims to stimulate economic growth by making borrowing cheaper, thereby encouraging spending and investment. Conversely, raising the rate is intended to cool off an overheating economy and rein in inflation. This dual mandate of fostering maximum employment and stabilizing prices is critical in navigating the complexities of the U.S. economy. Furthermore, the Fed plays a significant role in the supervision and regulation of financial institutions to ensure the safety and soundness of the banking system. This function gained particular prominence following the financial crisis of 2008, which exposed vulnerabilities in the banking sector. The Fed conducts stress tests to evaluate the resilience of major banks against hypothetical adverse economic scenarios, thereby promoting transparency and accountability. The regulatory frameworks established by the Fed, and in collaboration with other regulatory bodies, aim to protect consumers and uphold public confidence in the financial system. Additionally, the Federal Reserve serves as a lender of last resort to financial institutions. This role is critical during times of economic distress when banks experience liquidity shortages. By providing emergency loans, the Fed aims to prevent bank runs and stabilize the financial system. The creation and expansion of facilities designed to support liquidity, particularly during crises like the Great Recession and the COVID-19 pandemic, illustrate the Fed's commitment to maintaining financial stability while also fulfilling its responsibilities under the broader economic framework. Another important function of the Federal Reserve is managing the nation's payment systems. The Fed facilitates the smooth functioning of these systems, which are essential for the transfer of funds between banks and for the processing of transactions across the economy. Through its development and oversight of payment infrastructures such as the FedWire and Automated Clearinghouse (ACH), the central bank ensures efficient and secure transactions, thereby promoting confidence among consumers and businesses alike. The Federal Reserve also contributes to economic research and data collection, which underpin its policymaking process. By analyzing economic trends and monitoring key indicators such as employment, inflation, and GDP growth, the Fed uses this data to inform its decisions and communicate its rationale to the public and financial markets. This transparency is crucial in managing expectations and fostering rational behavior among economic agents, which can ultimately reinforce the effectiveness of its policies. The Federal Reserve's monetary policy is often debated, particularly regarding the timing and magnitude of its interventions. Critics argue that the Fed's policies can lead to unintended consequences such as asset bubbles or income inequality, while supporters highlight its success in navigating economic crises. The complexities of the modern economy, coupled with the challenges of balancing multiple goals, underscore the importance of ongoing evaluation and adaptation of the Fed's strategies. Consequently, the institution continues to evolve, responding to both domestic and global economic shifts. Moreover, the Federal Reserve has gained international significance as its policies can have far-reaching impacts beyond U.S. borders. As the world's largest economy changes in U.S. monetary policy can influence global capital flows, exchange rates, and trade dynamics. Consequently, central banks from various nations closely monitor the Fed's actions and statements. This interconnectedness underscores the necessity for the Federal Reserve to communicate effectively and work collaboratively with other central banks to address global economic challenges, particularly in an era defined by increased financial globalization. Monetary policy implementation. One of the primary functions of the Federal Reserve is the implementation of monetary policy, which involves managing the nation's money supply and interest rates to achieve macroeconomic objectives. The Fed employs various tools, including open market operations, the discount rate, and reserve requirements, to influence economic activity. By adjusting these levers, the Federal Reserve aims to control inflation, maximize employment, and stabilize prices. For instance, during periods of economic downturn, the Fed may lower interest rates to encourage borrowing and investment, thus stimulating economic growth. Conversely, in times of excessive inflation, the Fed may raise rates to cool off an overheated economy. This dynamic approach to monetary policy is essential for navigating the complexities of the modern economy. Financial regulation and supervision. In addition to its monetary policy responsibilities, the Federal Reserve plays a critical role in the regulation and supervision of banks and other financial institutions. This regulatory framework is designed to ensure the safety and soundness of the banking system, protect consumers, and promote financial stability. The Fed conducts stress tests and capital assessments to ensure that banks can withstand economic shocks and continue to operate effectively. Moreover, the Federal Reserve is tasked with enforcing consumer protection laws, ensuring that financial institutions treat their customers fairly. By maintaining rigorous standards and oversight, the Federal Reserve helps to mitigate systemic risks that could lead to financial crises. Crisis management and lender of last resort. The Federal Reserve's role as a lender of last resort is particularly significant in times of financial distress. When liquidity issues arise, whether due to a sudden economic shock or a loss of confidence in financial markets, the Fed can provide emergency loans to banks and other financial institutions facing temporary difficulties. This intervention is crucial for maintaining stability in the financial system, as it prevents the failure of solvent institutions that could otherwise trigger widespread panic and economic downturns. The Fed's response during the 2008 financial crisis, for instance, demonstrated its capacity to act decisively in mitigating systemic risk through unconventional monetary policies such as quantitative easing. International economic influence. The Federal Reserve's influence extends beyond the borders of the United States, impacting global economic conditions and international financial markets. As the issuer of the world's primary reserve currency, the Fed plays a vital role in international trade and finance. Changes in U.S. monetary policy can have ripple effects across the global economy, influencing exchange rates, capital flows, and economic growth in other nations. Furthermore, the Federal Reserve collaborates with other central banks through international forums to address global economic challenges, ensuring coordinated policy responses during times of crisis. This international dimension underscores the Fed's significance not only within the U.S. economy but also on the global STA. International economic influence. The Federal Reserve's influence extends beyond the borders of the United States, impacting global economic conditions and international financial markets. As the issuer of the world's primary reserve currency, the Fed plays a vital role in international trade and finance. Changes in U.S. monetary policy can have ripple effects across the global economy, influencing exchange rates, capital flows, and economic growth in other nations. Furthermore, the Federal Reserve collaborates with other central banks through international forums to address global economic challenges, ensuring coordinated policy responses during times of crisis. This international dimension underscores the Fed's significance not only within the U.S. economy but also on the global stage. In conclusion, the Federal Reserve occupies a central role in the United States economic framework, serving as a linchpin for monetary policy, financial regulation, and crisis management. Its efforts to maintain economic stability and promote a sound banking environment are essential for fostering sustainable growth and protecting consumers. As the global economy continues to evolve, the Federal Reserve's influence will undoubtedly adapt, addressing new challenges and opportunities. Understanding the multifaceted roles of the Federal Reserve is crucial for comprehending the complexities of modern economics and the intricate interplay between national and international financial systems. Ultimately, the Federal Reserve remains a vital institution in safeguarding the economic prosperity of the nation and beyond. If you found this helpful, don't forget to like, subscribe, and hit the bell so you never miss a money tip. Drop a comment below with your thoughts or questions. I'd love to hear from you. Until next time, stay smart, stay savvy, and keep building your financial future.